any one of those things would have created a problem, but you've got all three. So
Well, don't
people who,
there's the fourth one, that you and I've talked about a bunch is as the risk-free rate of return has gone from nothing to 5%, the cap rates had to go up. And that is
yes,
just a killer. When you take all of those inputs and then you slap a higher cap rate on it,
yeah,
we can, do you remember, I think this was 18 months ago. You and I off the cuff built a spreadsheet where we took
yes,
$100 million building and we turned it into like 37 million with
yeah,
just some small tweaks to all three of these. That's really happening right
yeah,
now. We are seeing
yeah,
buildings that were worth 100 go for sub 40, just
yeah.
like we talked about.
And the thing is, it's funny because if you look at some of the indices that track deals, they're saying, well, prices have fallen anywhere from 13 to 25%. However, if you look at individual deals that are but the market is really thin because not much is
Yeah.
trading
No
right now.
transactions.
And then a lot of stuff is happening off what is trading, a lot of it's happening off market, and there are like these workouts going on. When you look at individual deals, you're seeing way bigger discounts
Oh, yeah.
than 13 to 20%. Those are only the things that are really trading at the moment, right? But the stuff that is the overhang that we're seeing right now on individual deals is much larger. So, you're looking at 30 to 40 to 50%
Oh,
discounts if you
yeah.
bought at the peak, right? So,
Yeah.
and then so just on the last sort of comment on this, a lot of these high flying syndicators were especially exposed to deals bought at the peak, right? So they, the people that have been in business for 10 years and have been buying deals all along and have, a big chunk of their portfolio still in deals that were purchased in, 2014, 15, 16, 17, they'll ride these things out. But the people who came into the
Well,
market,
one sec. They'll ride them out if they didn't refi and pull equity out.
well,
That's the
that's
other
true.
thing that,
Yes. Yeah, that's true. Yeah.
yeah, because a lot of them went back to the well. They thought they had all this money, they pulled the capital out. So if you did a refi in 2021, even if you bought in 12, you could still be shit
Yeah.
out of luck.
And listen, this is just not to make it. Let me finish up this point, and
Yep.
then I'll go. Then I'll make the second. So a lot of these newer groups that really came out of nowhere, right? And I noticed some of these folks, like around 2019 or so, every conference these people would have a booth, right? And they'd be like,
Yeah.
and giving away all kinds of free swag and all this sort of stuff.
Yeah.
And so these people came out of nowhere. I don't know where they got their backing from to do all of these, to do all this marketing, but their entire portfolio was essentially assembled at the top. And when interest rates went as low as they did in like 2021, they all went all in and just bought as much as they possibly could. And it
Well,
was all with floating rate debt.
I told you about my experience in 2018, right? I went to a San Jose meetup where I was the featured speaker. There's probably 150, 200 people in the room. I do those because I want to give back, but more importantly, I want to see what the audience wants. And
Yeah.
everybody, seemingly, let's call it 50%, probably more, were brand new syndicators. Never done a deal. They were in tech, so they and their couple of buddies had some money from options or stock. And I left that meeting and I sold. I sold a couple of
Yeah.
apartment buildings. I'm like, this is going to get bananas. Little did I know we'd have, the pandemic, but